The comments out of the Goldman conference were primarily positive, talking about some loan growth into next year, talking about how their consumers and their customers are reasonably healthy. But there were some words of caution about loan growth slowing a little bit, and also about consumer credit maybe being at its peak. And so therefore, as we were listening to the banks, people were expecting, after Monday's very strong rally, that the news would be all positive. And because it was a little bit mixed, that probably also contributed to the factors that you mentioned, the yield curve, the tariffs, the slowing down in growth.
When we heard from the big bank CEOs when we got earnings last month and maybe into the weeks before that, all of them were saying, look, things look great on the horizon. We can see out about 18 months and there's no need for concern. Did you hear that yesterday, or what you're describing, is that saying, maybe we can't see quite as far as we thought?
I think the horizon has come in just a little bit, Becky, and they're a little bit less positive, still looking for good loan growth, but not quite as enthusiastic as they were on the earnings calls last month.
Okay, Stephen, let's go back to what we saw with the yield curve. You're watching this very closely and say the first step people should be taking with their portfolios right now is maybe repositioning what they're seeing in fixed income.
Yeah, I think it's important to remember the yield curve has been a great indicator about the potential for recession, but not necessarily a great indicator around what you should do from an asset allocation perspective. Stocks generally rally over the last 7 or 8 cycles for the year after the yield curve inverts. And on average, you've seen 20% gains within equities. So we're not making wholesale changes within our equity allocations, but rather taking in some of the risks that we're seeing on the fixed income side of portfolio. So trimming some of our credit exposure, adding a little bit of duration, focusing on quality. So you have a little bit more of a defensive quality barbell in fixed income while still maintaining a positive outlook on equities.
That's kind of the move that a lot of people have been making, particularly when you look at corporate bonds, just concern about what happens at the lower rated areas.
Well, and I think that the other thing to keep in mind, there's a risk-reward trade-off, right? On the upside, we think that if things turn out better than expected, the upside you're going to get from equities is much better than what you're going to see from corporate credit. And on the downside, I'm not so sure that the defensive nature of high yield, and especially some of the lower credits, is going to protect you as much, even in an equity downdraft.
Richard, you're here, and we're great to have you because you knew 41 right. so well. But
I also know this guy.
But I can't help. I'm just dying to talk to you about what's happening with the Fed too, and just right. Get your. Where the hell are we? How did this happen? What's the most surprising thing? Since we've been watching and talking about this for years and years, all through right. QE 1, 2, and 3, and all through all the worries of what we were doing since the financial crisis. But now where are we? Were you expecting anything close to this in terms of the way it's played out?
Well, I was talking to Steve about this earlier. We applied Ritalin to the markets.
Ritalin?
Ooh. Monetary Ritalin, or lithium. And we started doing it in big spades, big doses, as we approached the first week of March of 2009. We had expanded the balance sheet by $1.75 trillion. We were sending a signal to the marketplace, discount future cash flows, literally mathematically to infinity. And now we're at 4x. We've compounded over the last 10 years, a little over 14% per annum. It's been a one-way street. As we were talking about, by 2017, there was no volatility. We actually heard the term meta stability. Everything's meta with the younger generation, but it was no question that at some point...
You're talking about me.
Yeah, you're meta stabilized.
Compared to you, yeah, I'm the younger.
But there's no question that at some point a price would be paid. And we created a one-way street.
Is that what's happening right now?
Is this ADHD, or is just this a return to normality?
I think it's a return to normalcy, but it's very hard to withdraw from that dependency.
You mean we're stuck? We can't get out? We're stuck in the Roach Motel?
I'm not saying we're stuck. We will get out. We have to
get out.
It's tough, though.
But it's going to be slow on the way out.
It's going to be slow. It's also going to be painful.
What's the pain look like?
Well, I think we've seen some expressions of pain.
Well, how can
we've also seen an expression of the moodiness. What scared me about
this is not terrible pain, though. We can deal with this pain.
I made my money in 1987. We were down 800 points. That was 20%.
23, yeah.
Fortunately, I was short, so I'm still living off of that, Joe.
Yeah.
Many years later, 800 points, not very much right now. So here's the point. You've had a one-way street. It's gone on for over a decade. A lot of people in the business have seen nothing else. We're also on the back of the greatest bond market rally, according to the Bank of England, starting with Volcker. The second greatest bond market rally in 800 years of history, going back to Genoa and Venice.
Was any of that?
So, you're seeing a turn. Those turns are very painful. It takes really smart people like these two guys to figure out how to navigate that kind of thing for their firm.
But my question, did you know that interest rates this low would be considered neutral and could actually start choking off?
By the way, on that speech, to me, Mr. Powell made an observational comment. The range that's been estimated by the guys that plot the dot plot, remember I was a dot for a long time, for 10 years, is from neutral rate 2.5 to somewhere above 3. Well, he's right. One more move and you're at the lower end of the range.
Well, why? It feels weird to me that it's not 6% because that's what I was used to. I thought that companies can do fine. Companies can do fine at 6%.
You're an old guy. I mean, this is a new era. But still, here's what I believe they're still doing. Powell and the committee are being good squirrels, as I've said before on the show. They're putting nuts in the tree. And by the way, not squirrels that run back and forth in front of your car when you're driving down the street. That's not what you want for the Fed. You want them to store up rate increases so that when the cycle turns, you can mitigate the downturn by cutting, also by perhaps expanding your balance.
Were we too loose with the money, so now we can't, the slightest increase?
I voted against QE3.
I know, but the slightest increase, suddenly we got to pay that on the debt service. Is that why we're in this soup?
Well, this is another real problem we have, and I'd be interested in their views, because as the Fed is cutting back its balance sheet, next year the federal authorities will issue $1.35 trillion more in Treasury debt. That creates pressure, particularly in the 2 to 7 year space on the yield curve. I think that's why those auctions have been a little bit sloppy. And that, in turn, impacts how you discount the present value of future cash flows when you're buying something else. So rates are on the directional sign is upward in that end of the curve out to the 10-year. But you probably have more informed views than I do.
What do you think about that, Ellen?
It's clear that there's been pressure on the end of the curve. And the end of the curve, in addition to those technical factors, really also represents the market's best assessment of what the growth is. And as we look into 2019 and potentially into 2020, we're seeing growth slow down. We're seeing GDP slow down. We're seeing China slow down. We're seeing Europe slow down. We're seeing the after effects of the tax cut. And so in addition to the technical factors, the long end of the curve is reflecting slower growth. And that's going to continue to be difficult to digest for the market and probably lead to continued higher volatility as we've seen over the course of this year.
How much of this is slower growth and how much of what we're seeing in the 10-year is a reflection of what we see in the 10-year overseas? The German Bund, the 10-year there, also yielding at one point today 0.24 something, which is the lowest levels we've seen since May.
Well, and that's the other thing to keep in mind. Fixed income, it's a global market. So we've seen a big move off of the recent historic lows. But relative to the rest of the world, rates are actually look pretty high comparatively speaking. Now, you have to assume some sort of dollar stability to get international foreign investors to really get excited. But I also think from an equity perspective, if you turn it around, there is a relative trade looking outside of the U.S. into emerging global equity markets where monetary policy continues to be much easier relative to where we are in the cycle here in the U.S.